Good evening. This is Doc Severson for the TheoTrade Nightly Report for Tuesday, June 7th. I'll start out here with a daily chart on the S&P 500 or the Spiders ETF, and something happened today that was a little bit different than what we've seen for quite some time. We had late day selling. So in the last hour, we saw selling coming into the markets. And so far, this has created this little shooting star candlestick. Now, you can see where the upper shadow on this is actually much, much higher than the actual real body for this. And this is very different from where we saw last week, where all the shadows were to the downside. Now, if we kind of zoom in on this move that we've had since last Friday, you can see that this has just been, after this reversal, a series of higher highs and higher lows that are basically trading within this channel all the way until the last hour today. So this looks like this channel, which has really been in place throughout this price action, has been broken to the downside. So what does that mean from here? If I zoom out to the major time frames here, such as the monthly, the weekly, and the daily charts, I think we can get a better picture on what's going on here. So first of all, just the larger term context is that we have this monthly consolidation, which is good for about 300 points on the S&Ps. Now, as we know, markets can correct through either price or through time. And I believe what we're seeing here is a market correcting through time. Since it's spent an awful long time, I mean, essentially it's spent since the fall of 2014. So we're coming up on 2 years being stuck in this range, and this is the equivalent of winding up a spring. Now you can get the same effect for this by just pulling back, as we did back through both of these recessions that came along, right? So in effect, what's going on is we're having sort of our own little recession. Certainly we have an earnings recession going on right now, but with the price parked against all-time highs right now, this is the price telling us that it doesn't really care about this, that it all comes down to central bank policy as usual. And this is really the era of central bank policy that we've had really ever since the 2010 timeframe back here, where Bernanke announced quantitative easing from Jackson Hole. And you can see essentially how much of a different market we've had since that point. So from a larger context, what we have to do is understand that either we're going to continue to trade within this range, or we are going to break out outside of this range. And right now what the price is trying to figure out is whether or not there's enough of a catalyst to break us out above and beyond the current range. Forget about for a second whether or not you think the price has a right to be up here. I think we've all had our own opinions on what should have happened to the market and how the market should have reacted over the past few years, considering all the headwinds that it's had and sort of what we expected from the market. Instead, all of this liquidity, and the Fed has announced that they've even admitted this, is that they front ran the market to create the wealth effect. All right? So it is what it is. It's been in place now for 6 years. It's what we have to deal with right now. So we can't trade the market that we want. We can only trade the market that we have in front of us. So this is reality right now within this 300-point range. And it's a question of whether or not the price is going to break outside of this range or stay within it. To understand that answer, we need to watch the price. Forget about all the other indicators that are out there telling you one thing or another. The price contains all the answers that we really need. So if we focus our attention onto this chart over here on the right side, the daily chart, and in fact, let's zoom in on the daily chart. What we're going to find is that the price gives us certain signatures depending on what it does. So in other words, if we are going to be breaking out higher from this range, then what we'll likely see is some consolidation here over the next week or so, perhaps, and then we'll see whether or not the price is able to get above and beyond that. Now, if the price is able to get above and beyond and start to hit that 2214 level on the spiders, or 2140, we should see a huge amount of volume down here. So if we're watching volume, we should see a lot of volume, because there's going to have to be a lot of short covering is going to have to occur. A lot of new bulls are going to have to come into the market to push this thing up and over. There should be tremendous disagreement at that price level if this is going to be breaking up above and beyond that. Now, if you think that the market is going to be heading lower from here to test the bottom of the range again, what we'd have to see is we will not see the price just drop like a stone like this. That's not the way that the market acts. So unless there's some kind of nasty news event that comes into place, which nobody has anticipated, we're not going to get price movement like that. What we will see instead is that there is a process behind a reversal. And so what we'd have to see is we'd have to see the price initially pull back, maybe bounce higher, set up a lower high, and then start to work lower in much the same way that it did last fall, where it actually set up a lower high up here and set up a series of lower highs before it finally fell out of bed down here. Now, there is one more alternative that I don't really want to consider, but it could happen, is going to be a repeat of what we saw last summer, where we traded within a relatively small range. In fact, this was one of the smallest range price action sideways moves that we have seen, personally, that I've seen since 2006. So it's been 10 years since we saw something with a range this shallow. So hopefully we're not going to see that again. Hopefully we're going to start to see some movement and perhaps a little bit more implied volatility right now, because selling options has been a little bit more difficult. I'll finish out today's video by looking at crude oil. So this is the crude contract, continuous contract adjusted, and what we're seeing right now is what we call on the daily chart a rising wedge. So this one is actually playing out pretty nicely right now, is nicely charting here. And so what we're seeing is that we're seeing this as the price goes higher and higher. This is very typical, is that the volatility is contracting within here. So you're seeing the swings get smaller and the pullbacks get more shallow. The swings get smaller, the pullbacks more shallow, and it's just kind of just inching higher up here. Now, what also is problematic for this is that there's a lot of overhead resistance that's hanging right around at the 52 level. So it's got pretty much a free pass until it gets up to there, but then it's going to be difficult. There's another way that we can visualize this by looking at what's called the volume profile. Okay, so this chart is now shifted over a little bit, and we have the volume profile drawn on the right side. So the last candle for today you can see is over here. So you can still see the wedge that we were talking about, the rising wedge. Okay. Now what we need to look at are these peaks that are over here. This is where all the trading is being done. So this is the previous volume profile. And what you're going to find is that resistance and support are going to be signified by these heavy areas over here, and especially this one that's right around the 53 area. So what that means is that all of this trading that's occurred in this area is signified by this volume spike. Now, when there's a lot of trading in one specific area, that's where there is agreement between buyers and sellers in terms of what the price is. And when you see very little volume in here, this is where there is no agreement between buyers and sellers. So what this means to us as traders is that the price can find resistance in these peaks. So sometimes it's difficult for the price to get back up and into this area again. So you notice how difficult it was for the price to get into this peak here, and how long it stayed within this peak, and how it doesn't want to leave that area because there's general agreement between buyers and sellers. And so it's going to need to have some kind of catalyst to get up into and stay within this peak up here again. And so that tends to provide overhead resistance to these moves. Now, rising wedge patterns, just by their nature, rising wedge patterns eventually break to the downside. Rising patterns like this eventually will break to the downside. But what I've also seen is sometimes they will pop up very quickly. They'll squeeze higher from here, in kind of a runaway market fashion, and that's usually where we see the exhaustion or rejection for that level, and this is typically where we'll see that start to fade down from there. Now, traditionally what we've seen with rising wedge patterns is that they will immediately break to the downside and then will try to back test from below and then be rejected. But again, lately what I've seen is more cases of a rising wedge squeezing out to the upside first before then finding resistance and then fading from that level. So as we look out a week from now, we have a Fed meeting in about a week on the 15th, and the policy results as well as the Fed chairman conference. Are we really going to get something new out of that conference and that policy release? Based on the recent news between the jobs report and from Yellen's speech, I very much doubt that we're going to see anything new from there. In fact, the recent probability of a rate hike has been about 3% for the June meeting and not much more than that for the July meeting. So right now, every market out there is just in desperate search for a catalyst right now because it's so used to the Fed, and the Fed's not really giving it anything. In fact, the recent news that it's gotten from the Fed over the last few weeks in Fed speak has all been wrong. So don't be surprised if we see a little air pocket in the near future from people taking profits or some kind of unexpected news event coming along which has not been priced in. I don't think it's going to change the trend, and I think we'll still be sideways into the Fed meeting. So that's it for the TheoTrade Nightly Report. Thanks for listening, folks, and we'll see you tomorrow.